And let's take a look at James' question, number 2 via email. When using the portfolio tool and simulating a trade, I do not see in the money options. Mostly I see at the money and out of the money. Right? I'll explain all that in a second. During simulate trade mode, I don't know how to extend options to include in the money. All right, James, let's talk about the portfolio. Let's talk about the rollout opportunities, and let's talk about what you may or may not see. Oh, there we go. And what to do about it. So I looked at 2 of James's positions in his portfolio. This is for Khokon in a moment. And I want to go to rolling covered calls here. Now, I simulated a position on the Yandex, opened on March 2nd when the stock was around $42 per share, that initial pop-up. And we sold a March 6th, today's strike. I meant to do the 20th, I apologize. We simulated doing the March 6th, 39 strike for 370 for a return of about 1.6%. Now, when you're tracking any position in the PowerOptions portfolio, you can immediately see your current liquidation value versus current liquidation loss and expected gain or loss at expiration. This had a max return of 1.8% on the position. The index is down, though, to 39.51. What does that mean? It means we're still in the money with our 39 strike. But anytime you're in a position and you hit a trigger, you can go to the position analysis view from your position in the portfolio, and this gives you a breakdown of your current position. Again, the expected max profit, 70 cents or 1.8%. And did I read that expiration wrong? The 6th of March. That's very strange. In any case, so I need to edit this. I apologize. I had thought I'm going to select the 14th. I apologize. I thought I had the 14th or the 20th in there. Or the 13th, excuse me. Let me go to the 13th and keep the same 39 strike at my original price of 370. I apologize for that. Okay, so this is looking better. We're at a loss right now because the position has declined. We're still going to go to position actions and then position analysis. Gained on the short call naturally as the stock fell. Well, actually, we're not looking too bad, but we're a little bit underwater, 1.9% after 4 days. If the stock stays where it is in 7 days, we'll have the return of 1.8%. Here's our rollout opportunities. And now what James' question is that you can see on mine it's very similar. I could roll out to the 27th of March and increase the potential return if assigned by 2.6%. Increase my adjusted net credit, which would also increase my downside protection. This is a good roll. But we can go further out in time. We see some rolls to April, down to the 39 strike, the 39.50 at the money, slightly in the money, but not too much. So James was concerned about, what about other positions? Why am I not seeing rolling down to the 38 strike further out in time, the 37 strike further out in time? And it may be because of the settings we have in the background that the new percent return if assigned is not giving you an increase of at least 0.5 or 1% from where you are right now. In this case, we're still being slightly in the money. That being said, I can always simulate any rollout opportunity I want with just a few clicks on PowerOptions. If I don't see the rollout that I want, I can always go to What If Calculations. This takes me to the profit and loss chart. And as we mentioned, the stock's falling a little bit. It's at 39.51. I think James wants to remain in the money for better protection, even though in 7 days this could potentially still be the profit of 1.8%, the target I had. So we'll just go ahead and do that. We'll go to View Options. Now, I already have this added that we've sold this option. I'm going to click it again because I have to simulate buying back today. And I'm going to roll out 14 days from that expiration. 7 days from now, I'm going to go to March 27th, and I'm going to simulate selling, well, let's see the 36 call. Let's see what that gives us. All right, but I had to add in that first option first, so I have to simulate buying it back. And we're going to roll 2 weeks out in time from this expiration, March 13th to March 27th. We're going to sell the 36 strike, 3 points deeper in the money for a midpoint of around 475, I think. 480. Okay. So this increases my potential profit to 2.3%. I'm going to talk about this in just a moment. This curve profit loss chart. Why am I not seeing the hockey stick graph? I'll talk about that in a moment. So here's one of the dilemmas. The reason you might not have seen that 36 strike or deeper in the money is that right now you are at a loss. I get that, about negative 1.5% in my example. This was a simulation that was close to one of the returns that I saw that you had, James, of I think 1.6%. Now, if I hold it to expiration and the stock stays above 39, in 7 days I make 1.8%. Rolling out 2 weeks more to a deeper in the money strike price is going to give me a credit to lower my cost basis. But my new return is only going up by 0.5%, less than half of the expected max return. And I don't know if that's going to fit my trading plan. Personally, if I'm rolling out, I want to see a rollout opportunity that's increasing this by maybe 1% for every 14 days or so. That's personal. That's not in the background settings, James. But that's something that I want to consider. I don't know if this is it's defensive. It's a good defensive play to lower cost basis, but you're lowering your return. Still a decent return for now. Remember, it's not just a 14-day trade. We've been in it for almost 7 days, so we're actually setting out to a 21-day trade for 2.3%. That's not too bad of a return, really. Not exceptional, but it's not too bad of a return. But I'm only gaining a small amount from my current still max expected profit, which if the stock stays above 39, I will receive. Okay? Now, this curved profit and loss chart is existing instead of the standard hockey graph you expect, because the system is actually reading this as I've sold a 39 call for March, bought a 39 call for March 13th, and sold a 36 call. It doesn't read it that we bought to close it. But I do know that I got 210 benefit of premium in this case. So what I could simply do is clear these two out and drop my cost basis by 210, which would put us at 39.90. Was selling a 36 call at 480. That takes into account those other factors. There's my standard hockey stick graph with a 2.6% return. Okay, well, was it 210 or was it a little bit more? Maybe I'm sorry, maybe I read that wrong. Maybe it wasn't 210, but in any case, maybe it was about 220 or so. I'm sorry. In any case, that's how you can simulate the roll and see if it meets your specific goals for the position. Oh, I'm sorry, I would have gone up to 40. Let's just go up to 40. Anyway, I'll just try to match the 2.3%. There it is. Okay. So I just read the math wrong. My apologies, folks. There we go. So you can simulate that if you don't see that you want. Now, James, the other thing that I have to delve deeper into, I asked the programmers about it, or deeper into for you, and I talked to the programmers about it, is that this is the Yandex example where we're still slightly in the money with our existing call. We don't see anything more below that 39 strike, as you mentioned. But it's also dependent on what's available. Here's a Winnebago covered call that we've rolled a couple times during these Friday webinars to simulate how we might roll a covered call. From January 24th, a recent adjustment was on 211, going out to March 20th to be defensive. We rolled to the 60 strike. Well, stock's now down to 46.12. Okay. Our in-the-money option has now come deep out of the money. I want to consider rolling it. Same process, James. I'm going to go to position actions as you did and go to position analysis. Remember, I'm holding the 60 strike and the stock's at 46.12. Okay, so we're in a position here where we're currently at a loss of, 23.7% with a max return loss of 15.3%. Darn it. Okay. Earlier, 4:15, James, when I ran this scenario, I had opportunities to roll to the 17th of April, 45 and 40 strike when the stock was at 44.90, I think, 45.10. Maybe it was at 3.50, 3.45 this afternoon, shortly after you sent your question in. I was using that to illustrate that sometimes it does show in the money opportunities depending on what's available with the strikes. the Yandex position and I believe one or two of your other positions had single dollar strike differences. So it may have dropped down to the 38, maybe the 37, again, if that return for the roll matched the requirements that are in the background. On the Winnebago one, it did show me rolls out to, I believe, July at the 45 strike and the 40, and also in April at the 45 strike, going in the money a little bit more. And then the 40 strikes, of course, further out. But Winnebago doesn't have single strike differences, and I think that might be part of the problem, that it's not going more than 2 or 3% in the money from the existing strike. But I'm going to get that information for you. Unfortunately, my illustration didn't work out, and I apologize for that, but I did see them earlier. The deeper in the money positions were there and were available as well. Okay? All right. So that's how you can do it manually, by going to the what if calculations if you don't see the rollout that you want. And there's a full section of help videos up here to help you using the basics, spread tool in action, and of course simulating rollouts so you can get to your position exactly as you want it. Okay. One more time jumping back here. Another quick question. We're going to be quick with this one. I'm sorry. Yeah, we're going to be kind of quick with this one. This one was from Khokon. Similar management technique idea. I entered a bull put credit spread on CRM for March 20th expiration, 155, 150 strike. Stock has fallen sharply and is trading now at about 160. My initial stop was 157. Please discuss how PowerOptions tools would help to manage. What are the best 7 ways to do it? All right. Toggle back over to PowerOptions. Let's show you one thing first. Get quickly to where we wanted to be. All right, so what does he mean by the 7 ways? What Khokon is referring to is one of the popular webinars that we have, powerop.com/webinars.asp for the archives. This is a public page, so you can access most of this information. Oh, didn't copy for me, I apologize. You can access most of the webinars, I should say. There we go. At any time, just by going to this link. And under the Option Strategy section, if you scroll down, you'll see a webinar, 8 ways to manage a bull put credit spread. So our preferred 8 ways we might consider rolling a bull put depending on the current market conditions and the conditions of our position, our expectations going forward, our goals for the trade, which determines our action. Similar decision-making process that we use for the radioactive trading techniques. Now, let's go to recent bull puts. And here's Khokon's position. I went back using that historical chain we saw a moment ago, and I picked up the prices that were close to what we would have seen on March 2nd when the stock was at 174 for selling the 155, buying the 150 bull put spread. Your stop was at 157. It triggered that, but again, the stock recovered a little bit today in the mid-afternoon and at the end of the day. And so right now your liquidation value is a loss of only $5. Your expected profit, 50 cents, 11.1%. And if the stock stays where it is, you'd expect to have that in 14 days. Ideas for management, first step, just as we did before, position actions from any position I'm tracking, and position analysis. Breakdown of my current position, my current liquidation gain or loss here at market or at midpoint, and my expected profit and loss if the situation stays there. Now, down below it does show some rollout opportunities. Since the stock recovered, Khokon, now your puts are out of the money. A way to hedge it to increase the break-even to the downside, to lower the break-even to the downside, would be maybe to add an iron condor. Now, this is a little bit risky in these market conditions. This isn't one of the 8 that I would use, but it's an opportunity that shows, okay? And of course, what we would be doing here is I go to simulate trade from any rollout opportunity. Oh, sorry, folks. I could have done that on the profit and loss chart. Our covered call rollouts we were looking at before for James's question. There we go. But what we're seeing here is if we added a bear call credit spread naturally, we'd have a new position that would be an iron condor. We were going to sell the 180 and buy the 185. Okay, it's the same strike, so it actually would be this in this case. Okay. But with these market conditions, this is not one that I would do. Why? Because we're expecting to see snaps either this way or either this way. I don't think the market's really going to settle itself down anytime soon. That's why the hedging with the VIX, the hedging with the volatility, and proper position sizing are extraordinarily important. But what did this do? Well, my original cost basis was 50 cents, so my break even was going to be what? 154.50. With this new one, we drop it down by another 50 cents or so, 40 cents. And that's because we're getting in another net credit from this bear call side. We increase our return, but we do now have an upper break even, but we've changed our lower break even. The original position on the left in red, and a red here, new position in blue with the new break evens shown. Not a lot, but it gives you more cushion. Okay, so that's one way that you can check it, of course, is to analyze what's available. But we only see this one. And as we saw with James's question, what if I'm considering a different management and it's not available? Well, you could simulate it going to the what if calculations, have your profit and loss chart, and when the stock was at 157 or so, your short put was being threatened. Now, what are the management techniques? Quick review. Number one, do nothing. Okay. Part of Khokon's question is which one is best. And that's really something I can't answer because what does that depend on? That depends on the current conditions of the market. Khokon, your expectations of what you think or fear would happen next. What do I mean by that? Well, if I think the market's going to pause and move back up, maybe that leads me to number one, do nothing. If I'm concerned the market's going to keep whipsawing, well, yeah, then maybe I'm going to adjust this one of the other 7 ways. Maybe not the iron condor way, but maybe one of the other 7 ways. And then, of course, the goals. Well, the goals is to make money. The goals is also not to lose money and not to increase the potential loss via a management technique. So if you enter into an adjustment and you actually increase your risk, you increase your loss on the position in a whipsaw market like this, it might not be a good idea. And that determines your actions. Okay? So number one is do nothing. And right now we're kind of looking okay, although if it falls on Monday, we'll still be being threatened. Number two, you're at a loss right now, but we saw it was a small loss at midpoint, only $4. Close the position and move on to either another strategy or maybe another bull put spread that you think is better in this market. I have not opened a new bull put spread this cycle. My options were managed and adjusted last week before the expiration. That was the 2-week cycle I was on for my bull puts. I did not open any bull puts this week for the next cycle. I have none open right now. Okay, so mine was manage the positions last week. I pretty much just closed them to keep the losses under 40-45%. That's okay to take because of the structure that I'm using and the VIX calls, which hedge those losses in any case. But again, I closed them and I haven't opened anything new. All right, number 3. Close the position and roll down. Roll down the whole spread as you would with the covered call. So here's your existing bull put, and you load it, you go further out in time to lower strikes, which is probably going to lower your max return, but now you've got a safer cushion. Okay, close and roll down. Now, I'm not a fan of this per se, and this is one that I rarely ever use. Why? Because if the stock starts to go against me in normal market conditions, or if I'm in turbulent market conditions, but if the stock's going against me and my sentiment was wrong, why do I want to roll down here on a stock that's declining and keep in a bullish strategy and keep having to do this to go further and further out in time? Another caveat that comes with this is right now this would be a good position to maybe liquidate because you're only at a loss of $5 from the net credit you received. It looks small if you get midpoint. It's not a huge loss. You're not at a 40% loss or 50% loss of the maximum 450 you could lose on the spread, Khokon. Okay? But again, rolling down, it's going to lower the return. And if you are at one of those points where you took in 50 cents, but now you're at a $1.50 loss if you close this initial spread, or maybe at a $2 loss, to roll to a credit of 2 points, you're going to have to go either out 5 or 6 months out in time, or you're going to have to double or triple the strike differences, moving from a 5-point spread to a 10-point spread, more margin, i.e. more potential loss if it keeps moving against you, or 15-point spread. to get a $2 net credit, because the 5-point spread's even far out in time. If you're looking for that same range out of the money for a good probability, it's only going to be giving you 40, 50, 60 cents, maybe $1, not 2. The only way you're going to get $2 is to go ahead and expand the strike differences. More margin, more potential for loss. Okay. Number 4, I think is usually in my order, is close and do the opposite. Okay, close and do the opposite. What do I mean by that? You liquidate this spread for a loss, and then if your sentiment is telling you the stock is doing this and moving against you, open a bear call spread. Maybe 3, 4, 5% out of the money, looking for a net credit that covers the loss you originally took, on this position. Now again, for Khokon's example, that's all right because you're only taking a loss of 5 cents. It'd be easy to find a bear call spread. But this is a whipsaw market. It's a lot of risk in doing this because if it moves back up, now you're losing on the bear call spread where you've been full success of the bull put, But again, if I'm in that position where I'm taking a $1 or $2 or $3 loss in here, sort of the 25, 35, 50% loss of the max 5 points or max 450, and I need to get a credit and I'm closing and doing the opposite, I'm going to have to increase the strike differences and move further out in time, from your month out to expiration, or 14 days now to expiration, to maybe 3 months out or 4 months out or so. Number 5, I'm kind of out of order here, but that's okay. You can't do it with this one, I think. And it's usually maybe up here. It's usually number 3, and I think I'm out of order, but that's okay. The order isn't important. But the 5th idea is to close the short and roll it down 1. Don't move the long. Keep your long where it is. Close the short and move it down 1. When I looked at this position, I didn't see a 152.5 strike on CRM. I could have been wrong, but I don't recall seeing a 152 strike. So roll just the short down 1 if it still keeps a profit. What does that do? Gives you more cushion, a lower break even, but it is also going to lower the return, as did closing and rolling down out in time. Okay, so roll just the short is another option that you could use. Okay, so do nothing, close the entire spread, just get out of it and move on. Close and roll down. Close and do the opposite, which we talked about the problems. Rolling just the short leg down, which isn't available. Number 6 is rarely used, but in turbulent markets can work out well, but your cost would have been too high, I think, with the volatility increase, Khokon. What is number 6? Close the short only. If your sentiment has changed, you still have time remaining, in this case 10 to 14 days remaining on the position. I pay the money to buy to close the short, $1, $1.50. Took in 50 cents initially, so I pay $1.50 to close it, so I'm at $1 loss. What does that leave me with? Well, it leaves you with just, sorry folks, it leaves you with just a long put at the 150 strike for a cost basis of $1. And if CRM continues to move down, you just have a long put position that's gaining. This is not a management you can do 2 to 3 days to expiration. This is not a management you can do maybe even the week of expiration. But since you still have 14 days, if your sentiment has changed, you feel CRM is opposite of what you had when you opened the position, you might be able to just close the short, have just a long put now, but analyze the cost and the likelihood that if the stock does continue down, you'd hit your break even, in this example of 149, by the 20th. Number 7, you already saw. That was entering the bear call spread out of the money, 180 we looked at, 185 strike, to complete an iron condor. Gives you a new credit in. It's going to lower that lower break even for you because of the new credit, but now you also have an upper break even, and in a whipsaw market, we already talked about the risks of number 7. And number 8, of course, is the pendulum adjustment, which I only use if the stock is trading between the strike prices after a sudden fall. And the pendulum adjustment is, rather than closing my bull put and opening the opposite, I'm going to sell to close my long and buy an in-the-money put to convert my bull put to a bear put debit spread with one move. And if the stock continues down, I'll now have profit on the bear put debit, where I would have had more loss on the bull put. Typically, this only works when the stock you have a sudden fallness between the strikes. Okay, so do nothing. Looked like it worked out pretty well because the stock recovered today. You could have closed the position and taken a small loss. Close and roll down. I talked about pros and cons of that. I don't think that's necessarily the best approach in a whipsaw market. Neither is maybe close and do the opposite for the same reasons we talked about. It might not be the best idea to do number 7. Okay? Roll the short down. That wasn't available for us. Oh, sorry, folks. Close the short only, number 6. Might be an option if you think CRM is going to continue down, the market's not going to whipsaw up. And number 8, the pendulum, which works when it's between. So really, I'm looking at maybe just closing the short and leaving it as a long, closing the position in this case, taking that small loss, or do nothing until it gets threatened again, which I think is the decent approach at this time. But on Monday, of course, we drop. So if we have another drop like we've had, we see CRM going to 157. You're probably going to consider just closing the position, maybe just closing the short and leaving a long put open if it's not too expensive. In this whipsaw market, it's very dangerous to consider closing and rolling down or closing and doing the opposite and changing it to a bear call credit spread. Okay, so that's what I consider there on those. That's where I'm going with the CRM discussion. That's where I'm going with the discussion for our 8 ways to manage a bull put in this case. Of course, this has all been recorded there as well.